Welcome, curious minds, to another deep dive. Today we're unpacking a day on Wall Street that, from the surface, looked deceptively stable, but our sources reveal it was actually a swirling maelstrom underneath. We're talking about August 14th, 2025, and while the U.S. equity market just closed, the real story of what happened goes far beyond the headlines.
Indeed. While the S&P 500 technically eked out another record close, its third consecutive, in fact, our deep dive into the underlying data reveals a story of significant turmoil. We'll be exploring the day's central conflict, the surprising, almost fortress-like resilience of a few tech giants versus a broad-based sell-off that hammered much of the rest of the market. It was a day of stark contrasts, truly a tale of two markets.
Right. And our mission for this deep dive is to extract the most important nuggets of knowledge from the daily market reports you've shared. We're going to give you that essential shortcut to being truly well-informed about this pivotal day, revealing the surprising facts and helping you understand not just what happened, but, why these shifts matter for the bigger picture, for your investments and, well, the economy.
We'll dive into the single most powerful catalyst that dominated trading, a July Producer Price Index, or PPI, report that shattered nearly everyone's expectations. Then, we'll dissect precisely how this shockwave rippled through every corner of the financial world, from the bond market to the major indices and down to individual stocks, forcing a sudden, dramatic repricing of inflation risk and the very outlook for U.S. monetary policy. It was quite something.
Okay, let's unpack this fascinating day, peeling back the layers to see what it all means for you, our listener, who wants to quickly grasp the crucial insights without getting lost in the noise. So let's start right at the top, where the headline might have suggested a calm and successful day. You might have seen news flashes that the S&P 500 closed at yet another record high, its third consecutive, in fact, on August 14th, 2025. On the surface, that sounds like pure bullishness, right?
Right. Looks good on paper.
But here's where it gets really interesting. Our sources revealed this headline strength actually masked some serious underlying turmoil, almost like a beautifully painted facade hiding, well, a cracking foundation. What was truly going on beneath that seemingly stable surface?
What's fascinating here is that stark divergence. The day's trading was completely dominated by one powerful catalyst, the July Producer Price Index, or PPI, report. This report came in dramatically hotter than anticipated, absolutely shattering the market's near-unanimous consensus for an imminent Federal Reserve interest rate cut.
So everyone was expecting a cut.
Pretty much a lock, yeah. Before the report, the market was almost certain a cut was coming. This data immediately introduced conflict and uncertainty, fundamentally reshaping expectations.
That makes sense. And this conflict, as you said, played out as a clear tale of two markets. On one side, you had the surprising resilience, even strength, of a handful of mega-cap technology stocks, which genuinely kept the major indices like the S&P 500 afloat.
Right, the big names.
And on the other, you had a broad-based, almost aggressive sell-off in smaller, more economically sensitive companies. It's not often you see such a stark split.
This divergence is critical because it reveals a market grappling with a sudden, forceful repricing of inflation risk and, consequently, a radical shift in the monetary policy outlook. The session was characterized by a sharp spike in Treasury yields, indicating rising borrowing costs, alongside extreme volatility in individual stocks that were reacting intensely to forward guidance.
Guidance was key then.
Absolutely key. There was a palpable sense of uncertainty that replaced the previous day's bullish confidence, a rapid psychological shift from optimism to a much more cautious, almost defensive stance. Investors were forced to fundamentally reevaluate their entire investment thesis in a matter of hours. It was whiplash.
Can you give us some quick, concrete examples of these winners and losers you just mentioned? Who were the swearers and who really felt the squeeze from this sudden shift?
Absolutely. On the losing side, companies highly exposed to tariff pressures and general economic caution felt severe pain. For instance, the fashion conglomerate Tapestry, the parent company of Coach and Pete Spade, which has significant international exposure.
Right, TPR.
Yet TPR saw its shares plummet over 15%. Similarly, the industrial giant Deere, DE, deeply intertwined with global trade and agricultural cycles, dropped nearly 7%. These are companies whose fortunes are tied to the broader economy and trade policies.
Makes sense. And the winners.
In stark contrast, those with strong, de-risked growth narratives, often in the technology space, saw explosive gains.
Yeah.
The technology infrastructure provider TeraWulf, WULF, for example, soared over 54%.
Wow, 54%.
Yeah, as its future growth was suddenly perceived as insulated from these broader macroeconomic headwinds. It was almost a flight to quality within growth sectors.
So as we connect this to the bigger picture, Our sources describe the market closing not in a state of outright panic or collapse, but rather at a critical inflection point. It sounds like a pause, a moment of deep reevaluation, rather than a full-blown retreat. What's the real takeaway here? It's not just that the market paused, but that this pause fundamentally redefines what strength means on Wall Street, isn't it?
That's precisely right. The exceptionally strong second quarter earnings season, which saw companies across the S&P 500 deliver solid profits, has provided a fundamental floor, preventing a complete collapse. Companies are generally doing well operationally. That helps.
Okay, so earnings were a buffer.
Exactly. However, the reemergence of wholesale inflation, as starkly evidenced by that PPI report, has now introduced a major headwind. It's forcing investors to seriously question the sustainability of the summer rally and, crucially, the rich valuations underpinning it.
Valuations have been pretty high.
They have. The day's action was a clear and unambiguous warning. The future gains will be harder fought, far more selective, and increasingly subject to macroeconomic realities. It's a fundamental shift from a broadly optimistic rising tide, where most boats were lifted, to a much choppier, more selective environment. Every investment decision will now be scrutinized for its sensitivity to inflation and interest rates.
All right, let's dig into that single powerful catalyst you mentioned, the July Producer Price Index report. How did this data drop at precisely 8:30 a.m. Eastern Time send such an immediate and dramatic shockwave through the market? It sounds like it hit with the force of a meteor, completely blindsiding traders.
It truly did. The market's prevailing narrative, a comfortable story of contained inflation that was gradually easing, was abruptly and fundamentally upended. The data painted a picture of wholesale inflation that was not only accelerating, but doing so at a pace that caught economists and traders entirely by surprise.
So the expectation was for things to keep cooling down.
Exactly. The expectation was for continued disinflation, a gentle easing of price pressures that would give the Federal Reserve room to cut rates. But what we got was quite the opposite, a significant, broad-based reacceleration.
Wow.
This wasn't just a slight deviation from expectations, it was a fundamental shift in the entire inflation outlook, forcing an immediate and sharp reassessment.
How surprising was it, numerically speaking? Give us the nitty-gritty details. What were the specific figures that really made the market sit up and take notice?
Okay, the headline, Producer Price Index for Final Demand surged by a staggering plus 0.9% month over month.
0.9% in 1 month.
Yes, and to put that into perspective, consensus expectations, which guide so much of market pricing, were for a modest plus 0.2% rise.
So more than 4 times higher.
Exactly. This represented the largest single-month increase in wholesale prices since 2022,
Right.
immediately signaling a sharp and alarming reversal of the disinflationary trend that had comforted markets in recent months. It was like expecting a gentle breeze and getting hit by a sudden, powerful gust.
Wow. Largest since 2022 is incredibly significant. That implies a real acceleration after what many thought was a period of calming prices, especially after that recent CPI report. Was this just a 1-month blip, or did the year-over-year picture reinforce a longer, more concerning trend?
On an annualized basis, the picture was equally concerning, reinforcing the severity of the problem. The year-over-year PPI jumped to plus 3.3%.
3.3%.
Right, decisively crushing the median forecast of plus 2.5% and marking a 5-month high. And crucially, this wasn't just volatile components like energy or food driving the surge.
Ah, so the core number was bad, too.
Exactly. The core reading of the index, which strips out those more volatile elements to give us a clearer view of underlying persistent price trends, offered no relief whatsoever.
Yeah.
It also rose plus 0.9% month over month and accelerated to plus 3.7% year over year.
Wow. Core at 3.7 year over year.
These core figures were substantially stronger than their respective forecasts of plus 0.2% and plus 3.0%, indicating that the inflationary pressure was broad, embedded across various sectors, and not simply a fleeting spike in a few commodity prices. This breadth is what makes it particularly worrying for central bankers.
Okay, so it's broad, surprising, and persistent. What specific elements within the report were driving this surge? Where was the pressure really building up?
A significant portion of the increase was fueled by the services sector, which has been a persistent source of sticky inflation. Notably, a 3.8% jump in machinery and equipment wholesaling alone was responsible for approximately 30% of the entire services increase.
Okay, machinery and equipment. That sounds fundamental.
It is. Think about the ripple effect here. If the cost of getting fundamental machinery and equipment from a wholesaler goes up significantly, that cost will inevitably ripple through manufacturing, construction, and other industries.
Ultimately impacting the final price of goods and services.
Exactly. But perhaps most critically for the market's narrative, trade services margins expanded by 2%.
Trade services margins. Okay. And why is that particular detail so critical? What makes that specific data point so important?
Because analysts immediately interpreted this as the first robust piece of hard evidence that producers are beginning to successfully pass tariff-related cost increases onto their customers.
Ah, so the tariffs are finally being passed through.
It looks like it. For a long time, businesses were absorbing these escalating input costs, particularly those stemming from ongoing trade disputes and tariffs, to maintain market share and consumer goodwill. However, the expansion of trade services margins directly shows that they've reached a point where they are now pushing these costs downstream.
Okay.
This data point provided a direct, quantifiable link between ongoing trade policy and the resurgence of wholesale inflation. It's a concrete sign that the financial burden of trade friction is no longer just an internal business problem, it's rapidly becoming a consumer problem.
So this surprisingly hot PPI report completely contradicted the more benign Consumer Price Index, or CPI, data that had just been released 2 days prior on August 12th. That CPI report had actually reinforced the market's belief that inflation was contained and paved the way for a Fed easing cycle.
Right. Total whiplash.
It's like the market heard two completely different tunes in the span of 48 hours.
Exactly. This creates what our sources call a pipeline pressure scenario. The willingness and, more importantly, the ability of businesses to absorb higher input costs, particularly from tariffs, may be waning. They're at a point where they can no longer simply absorb rising expenses without it significantly impacting their bottom line.
Okay, so something has to give.
Right. This suggests one of two difficult outcomes is likely in the coming months. Either corporations will indeed see their profit margins compress as they continue to absorb these costs.
Which hits their earnings.
Correct. Or they will successfully pass them on to end users, which would inevitably lead to a future acceleration of the CPI, creating a new wave of consumer inflation.
Neither sounds particularly good.
No. That's the core inflationary risk that the market is now grappling with, and it's a stark choice.
And that dynamic places the Federal Reserve in an exceptionally difficult, almost impossible position, doesn't it? They have to weigh the current, more moderate consumer inflation against the potentially hot inflation signaled by this producer pipeline.
Absolutely. This policy conflict was a primary driver of the day's uncertainty and the volatile divergent price action we observed. They're looking at the finished product on one hand and the cost of raw materials on the other, and the two reports are telling very different stories about the future. What a tightrope they're walking.
Speaking of the Fed, that pipeline pressure you just described, directly linked to this scorching PPI report, brings us squarely to the Federal Reserve. The market's reaction to the PPI data was immediate and focused squarely on the outlook for U.S. monetary policy. This report effectively vaporized the certainty that had surrounded the Federal Reserve's upcoming September meeting. It sounds like it just vanished.
That's truly an understatement. Prior to the 8:30 a.m. ET release, futures markets, as tracked by the CME FedWatch tool, which helps traders gauge the probability of Fed rate changes.
Right, the FedWatch tool.
Yeah, they were pricing in a 100% probability of a 25 basis point interest rate cut at the September FOMC meeting. 100%.
Wow, sure thing.
A basis point is just 1/100th of a percentage point, so 25 basis points equals a 0.25% cut. This consensus had been building for weeks, fueled by previous softer inflation and jobs reports. For many traders, the September rate cut was a foregone conclusion, almost a guaranteed event.
And how quickly did that absolute certainty disappear? Was it like, boom, gone?
Pretty much. It was a sudden, dramatic shift. Within hours of the PPI release, those odds plummeted. The probability of a rate cut for September, as indicated by FedWatch, plunged to the 93–94% range. Still high, but not 100.
Okay, so still likely, but not certain anymore.
Exactly. And even more significantly, the probability of the Fed choosing to hold rates steady, meaning no cut at all, materialized from 0 to over 7%.
7% chance of no cut. That's a big change from 0.
It is. A possibility that wasn't even on the board suddenly became a tangible, albeit still small, concern. And those small but persistent bets on a more aggressive 50 basis point cut, completely extinguished, gone.
Okay, so forget a big cut.
Yeah. Market went from absolute conviction to a clear questioning of the Fed's next move in a matter of hours. showcasing just how reactive it is.
Chris Larkin, managing director at E-Trade for Morgan Stanley, commented that this doesn't slam the door on a September rate cut, but it may raise a bit of doubt. That perfectly captures the market's abrupt transition, doesn't it? From unwavering confidence to tangible uncertainty.
It really does, and this raises an important question. What are the implications of this shift beyond just the single September meeting? Our sources indicate the market's reaction reflected a fundamental repricing of the entire expected easing cycle for the remainder of the year.
Ah, so not just September, but the whole outlook changed.
Right. It's not just about one quarter-point move. It's about the overall trajectory and speed of interest rate reductions.
So what was the broader expectation before, and how dramatically did this one report really shift the long-term outlook for rates?
Before the report, traders have been pricing in a total of 3 quarter-point rate reductions before the end of 2025.
3 cuts this year was the baseline.
Yes. This implied a steady easing path throughout the latter half of the year. After digesting the PPI data, that expectation was revised downward to just 2 cuts.
Okay, so 1 less cut expected for the year.
Correct. This represents a significant hawkish shift in the market's medium-term outlook. We're talking about potentially 25 basis points less of monetary easing than was anticipated just the day before, meaning financial conditions would remain tighter for longer than previously expected.
So a higher for longer interest rate environment than was priced in just 24 hours prior. That must fundamentally alter the valuation calculus for long-duration assets, particularly those high-growth tech stocks.
Exactly. Their premium valuations are heavily dependent on low future discount rates.
It's like changing the gravity for space launches suddenly. Everything needs more fuel, right?
Precisely. Their future earnings become less valuable when discounted at a higher rate. It also explains the severe reaction in assets most sensitive to borrowing costs, such as small-cap stocks and the bond market itself.
Small businesses and companies with heavy debt.
Exactly. They're much more susceptible to rising interest rates because their cost of capital goes up, impacting their profitability and growth prospects. The market was not merely questioning one policy decision. It was forced to question the entire disinflationary narrative that had propelled the powerful summer rally. This puts a significant crimp in the argument for continued, rapid, broad-based gains, forcing investors to be far more selective and cautious.
While the equity market's reaction to this inflation data was complex and mixed, the U.S. Treasury market sent an unambiguous signal of concern. Bond investors are often the first to react, right? And they sold off government debt, pushing yields sharply higher across the curve.
That's right. The bond market, ever the stoic realist, didn't bother with the facade the S&P 500 put up. It just directly reflected the new reality. The yield on the benchmark 10-year Treasury note, which is a critical barometer for borrowing costs across the entire economy, mortgages, corporate debt, everything.
The 10-year yield, yeah.
It surged in the wake of the report. It climbed from a pre-data level of 4.20% to close the session around 4.29%.
Wow, nearly 10 basis points in a day. That's a big move for the 10-year.
It is a significant intraday move, clearly showing how quickly and severely inflation and interest rate expectations shifted within the fixed income market. Bond prices fall as yields rise.
And the long end of the curve saw an even more pronounced reaction, didn't it? That suggests concerns go beyond just the immediate Fed meeting.
Indeed. The 30-year Treasury yield experienced its largest single-day gain since July 11, rising 5.5 basis points to settle at 4.882%.
4.88, getting close to 5% again.
Yeah. This move on the 30-year bond indicates that the market's concerns were not merely about the next Fed meeting or even the next few months, but about the potential for more persistent inflation over the long term. When long-term yields jump like that, it signals a fundamental reassessment of future inflation and the trajectory of long-term interest rates.
Our sources also mentioned other indicators reacting. WTI crude oil rose 2.1% to around $64 per barrel, maybe reflecting renewed inflationary pressures.
Could be, or just supply-demand dynamics.
Bitcoin pulled back 2.73% after setting a new all-time high overnight above $124,000. A retreat from risk, maybe?
It seems likely, a classic risk-off move for crypto.
And the VIX, the CBOE volatility index, often called the market's fear gauge, increased 4.07% to 15.07, but remained historically low.
Right, the VIX jump wasn't huge, which is interesting in itself.
It's a fascinating mix of reactions, isn't it? Almost as if different parts of the market were absorbing the news in different ways.
That's a keen observation. The decisive and distinctly negative reaction in the bond market can be viewed as a more truthful indicator of underlying sentiment than the seemingly flat performance of the major equity indices.
Why is that? Because the indices can be skewed.
Exactly. Equity benchmarks, particularly market cap-weighted ones like the S&P 500, can have their performance skewed by the outsized moves of a few mega-cap components. For example, a 3.5% gain in a behemoth like Amazon, with its massive market cap, can easily offset modest losses across dozens of smaller companies.
Right, giving a misleading picture of market health.
Precisely. The bond market, by contrast, acts as a more direct and democratic reflection of aggregate macroeconomic expectations, because every bond issue reacts directly to changes in interest rate and inflation expectations. It's like taking the collective pulse of the economy, rather than just listening to the heartbeat of a few giants.
So, the sharp rise in yields is the bond market's clear verdict. Inflation risk has demonstrably returned, and the Fed's capacity to cut rates aggressively is now seriously in question. What are the tangible consequences for equity valuations? How does this bond market move directly affect stock prices, especially for growth companies?
While higher Treasury yields directly increase the discount rate used in financial models to calculate the net present value of a company's future earnings.
Okay, the discount rate goes up.
Right. Think of it this way. If money you can get from a safe government bond offers a higher guaranteed return, then the future, less certain, earnings from a risky stock have to be discounted more heavily to make them attractive today.
Makes sense. Future money is worth less today if safe returns are higher.
Exactly. A higher discount rate makes those future earnings less valuable today, putting downward pressure on the entire market. And this impact is disproportionately felt by growth stocks, particularly in tech, whose valuations are most sensitive to these long-term rates because their projected earnings are weighted heavily in the distant future.
So it hits tech harder.
Generally, yes. This has created a dangerous tension. While the S&P 500 sits at a record high, the bond yields that underpin its valuation have moved decisively against it. This suggests the equity market is either ignoring the clear signal from its fixed income counterpart or is dangerously complacent.
And that disconnect can't last forever.
Historically, no. It's a condition that cannot persist indefinitely without a reconvergence. The two markets are telling very different stories, and eventually one has to yield to the other.
After what was truly a volatile session, spent mostly in negative territory, the major U.S. indices diverged into the close, really telling that story of broad weakness concealed by mega-cap strength. It's absolutely critical to distinguish this mixed performance from the strong, broad-based rally of the previous day, Wednesday, August 13th. That was different.
Completely different. Wednesday was broad participation. Thursday was narrow. The S&P 500 somehow managed to claw its way back from significant session lows to finish fractionally higher, securing a third consecutive record close, up approximately a mere plus 0.03% to 6,466.21, barely positive.
0.03%, practically flat.
Exactly, despite all the macroeconomic headwinds we've discussed. But reports on its exact change varied, highlighting just how razor-thin this gain was. This almost imperceptible positive close truly underscores the point that the headline number was deeply deceiving. It was teetering on the edge of negativity all day.
And what about the other major indices? Did the Dow and NASDAQ manage even that tiny gain?
No, they didn't. The Dow Jones Industrial Average and the NASDAQ Composite both ended the day with minor losses, slipping by less than 0.1% each. The Dow at around 44,758.79 and NASDAQ at 21,713.12, so slight erosion there.
Okay, so even among large caps, the weakness was broader than the S&P suggested.
Correct.
But here's where the real story lies, isn't it? The Russell 2000 index, which tracks U.S. small-cap stocks. This is often where we see the true, unvarnished health of the broader economy reflected.
This is indeed the most telling performance, acting almost as a canary in the coal mine. The Russell 2000 tumbled a market-leading 1.2% to 1.5%.
Over 1% down for small caps.
Yes, closing around 2,296.60, truly revealing the extent of the market's widespread risk-off sentiment. Unlike the S&P 500, buoyed by a few giants, the Russell 2000 is far more representative of the collective health of a wider array of businesses, particularly those more sensitive to domestic economic conditions and, crucially, rising interest rates and tighter credit conditions. Its dramatic underperformance sends a clear signal.
This session was a textbook example of poor market breadth, wasn't it? Where the performance of the headline index is incredibly misleading.
Absolutely. The day's action wasn't a reflection of a healthy, robust market, but rather one supported by an increasingly narrow group of mega-cap stocks.
Like seeing only the tallest skyscrapers standing strong while the rest of the city below is struggling.
That's a good analogy. Our sources indicated the gains from a few influential big tech companies, like Amazon, genuinely helped mask widespread losses. Get this, an estimated 3 out of every 4 stocks within the S&P 500 actually finished the day in negative territory.
3 out of 4. Wow. So the vast majority were down.
That is a staggering figure. It means the vast majority of companies felt the pain of the inflation report and interest rate uncertainty, even if the headline S&P number didn't show it. This kind of narrow leadership is often a warning sign.
So this dynamic represents a classic risk-off signal within the equity market itself. Investors weren't fleeing equities entirely, but were crowding into perceived safe haven mega caps,
Companies with fortress balance sheets, huge cash flow.
while aggressively selling smaller, more cyclical, and rate-sensitive companies. This type of market structure where a few generals lead while the troops retreat is inherently unstable, isn't it?
It really is. We've seen periods like this before. A rally built on such a narrow foundation is highly vulnerable to a sharp correction should one or two of those leading stocks falter. It's precarious.
So the foundation is weaker than the headline suggests.
Significantly weaker. The dramatic collapse in the Russell 2000 is a direct and unambiguous consequence of the day's macroeconomic developments. Small-cap companies are typically more dependent on borrowing and sensitive to the domestic economy. Their dramatic underperformance is the market's stark way of signaling that the combination of sticky wholesale inflation and the prospect of higher for longer interest rates poses a direct threat to the broader U.S. economy. Even if a few tech giants can weather the storm, it's truly the canary in the coal mine.
And given this tale of two markets and the dramatic shift in sentiment, what does our deep dive tell us about which sectors weathered the storm on August 14th and which succumbed? Were there clear winners and losers among industries?
Well, while comprehensive, real-time sector performance data for the entire market was limited, the dominant themes and key individual stock movements allow for a very clear inferred analysis. Remember, the previous day, August 13th, saw a clear rotation into cyclical sectors like materials, healthcare, and energy.
Right, on rate cut hopes.
Exactly. The hot PPI report on August 14th completely reversed this optimistic sentiment, punishing those very sectors exposed to economic sensitivity and trade policy. A swift, brutal reversal.
So this wasn't a healthy rotation at all, was it? More like a panic flight from risk.
No, absolutely not healthy. It was a clear flight to perceived safety, specifically within the largest, most dominant companies, regardless of their formal sector classification. Companies with strong balance sheets, established market positions. Conversely, the market aggressively punished any company that exhibited cyclical or policy-related vulnerability.
So it wasn't sector rotation, it was big versus small, safe versus risky.
Pretty much. It was about investors seeking refuge in the perceived impenetrable fortresses of mega-cap balance sheets, seeing them as safer havens in an uncertain environment.
Let's talk about the inferred winners first. Who benefited from this flight to safety?
Okay, the strength of mega-cap technology and communication services was the primary reason the S&P 500 and NASDAQ avoided significant losses. The plus 3.5% surge in Amazon, AMZN for instance, was a major stabilizing force, given its huge market cap and diversified businesses.
Amazon had a great day then.
Yeah. Fractional gains were also noted in other Magnificent Seven constituents like Microsoft, MSFT, Alphabet, GOG, and Meta Platforms, Meta. In this context, these stocks weren't really traded as aggressive growth plays, but more as defensive havens.
Defensive tech. Interesting.
Yeah, investors sought refuge in their fortress-like balance sheets, immense free cash flow, global revenue streams, all seen as durable assets against macroeconomic headwinds. They're big enough to weather almost any storm.
And the inferred losers. Which sectors were hit hardest by the inflation fears, tariffs, economic sensitivity?
The sharp -7% to -8% plunge in industrial bellwether Deere & Co. DE. On fears of a cautious outlook points to significant pressure on the industrial sector.
Industrials took a hit.
Definitely. This sector is inherently highly sensitive to both economic cycles and, critically, the impact of tariffs on global trade and equipment sales. Deere's cautionary outlook, explicitly tied to trade policy, served as a stark warning for the entire industrial complex.
And we saw some really big hits in consumer discretionary, didn't we? The sector that relies on people feeling good about spending.
Yes. The collapse of Tapestry, TPR, which fell over 15%, highlights deep weakness among tariff-sensitive retailers and broader consumer discretionary names. Companies in this sector are caught in a difficult squeeze. Rising input costs from tariffs and potentially waning consumer demand if costs are passed on.
Yeah, a tough spot. If people get worried, discretionary spending is often the first to go.
Exactly.
And what about financials? With all the talk about interest rates and the yield curve, they must have felt some pressure too.
While specific detailed performance data isn't available, the steepening yield curve and renewed uncertainty over rates almost certainly weighed heavily on the sector, particularly regional banks.
Regional banks especially.
Yes, these institutions make up a significant portion of the Russell 2000 index, remember. They are highly sensitive to changes in rate expectations and the economic outlook. Their profitability models are directly tied to interest rate spreads, and uncertainty hits them hard. This undoubtedly contributed to the small-cap index's dramatic underperformance.
What's fascinating here is how this dynamic challenges traditional business cycle sector analysis. The market wasn't behaving like it was late cycle or in recession. It created its own categories.
Precisely. It sharply bifurcated into two distinct groups. The handful of megacaps that have become a market unto themselves, acting almost as defensive bond proxies.
And the rest of the market that remains subject to traditional economic pressures.
Right. Vulnerable to inflation, tariffs, interest rates. This makes conventional broad sector-based investment strategies exceptionally difficult. The market's behavior is being dictated more by size and balance sheet strength than by classic cyclical characteristics. It's a new kind of market dynamic.
So, if the big indices were hiding a deeper story, where can we find the most dramatic action? It was certainly at the individual stock level, wasn't it? Where company-specific narratives intersected with those broader macro fears.
Absolutely. The individual stock stories are incredibly revealing.
Our sources highlight the market's current obsessions. Forward guidance is paramount, the quality of AI growth is under scrutiny, and shareholder dilution is being severely punished.
Let's absolutely look at the guidance disappointments first, because these were some of the most telling stories of the day. They came from companies that reported strong historical results, impressive past performance, but were nonetheless brutally punished for cautious forward-looking statements.
So past performance didn't matter if the outlook was weak.
Not at all. The market is far more interested in what's coming next than what just happened.
Like Tapestry, TPR, the parent company of Coach and Kate Spade. Their brands seem to be doing well, so what went so wrong for their stock? They beat estimates, right?
They did beat estimates. Tapestry plunged a brutal negative 15.13%, one of the worst performers in the S&P 500. This happened despite reporting fiscal fourth-quarter results that beat Wall Street's expectations for both revenue and adjusted EPS, driven by strong Coach sales.
So the beat was ignored.
Completely ignored.
Yeah.
The entire sell-off was triggered by the company's guidance for the upcoming fiscal year. Management warned that its outlook included a significant negative impact of over 60 cents per share from tariffs and duties.
Ouch. Over 60 cents a share hit from tariffs.
Yeah, translating to a direct hit of approximately $160 million to its operating margin. This quantifies exactly how external policy is directly hitting their future bottom line.
That's a stark example. And Deere & Co., DE, followed a remarkably similar script, didn't it? Another blue chip punished for guidance.
It did. The farm and construction machinery giant dropped nearly 97%. In a narrative strikingly similar to Tapestry's, Deere also reported quarterly results that surpassed analyst forecasts. Normally good news.
But not this time.
No. The stock was sold off aggressively after management trimmed the high end of its full-year profit forecast. They cited cautious customer sentiment amid ongoing uncertainty, directly linked to the impact of tariffs and lower grain prices on farmers' capital expenditure plans.
So their customers, the farmers, are getting squeezed.
Right. If farmers are hesitant to invest in new equipment due to trade policy or lower incomes, that directly impacts Deere's future sales. The severe punishment of these two blue chips demonstrates that in this market, forward guidance is the only metric that matters. It's shoot first, ask questions later.
But it wasn't all bad news for individual companies. Some saw explosive gains, especially those with clear, de-risked growth stories, like TeraWulf.
Exactly. It raises the question, what separated these winners from the losers? Take TeraWulf, WULF, for example, the day's most spectacular gainer. Its stock soared an incredible plus 54.71% on massive volume.
54%. What was the catalyst?
A pair of transformative announcements that fundamentally reshaped its entire investment thesis.
Okay, what were they? How did they flip the narrative from Bitcoin miner?
TeraWulf signed two groundbreaking 10-year high-performance computing HPC and AI hosting agreements with FluidStack. Crucially, the deal is backed by a substantial $1.8 billion lease obligation backstop and a strategic equity stake from Google.
Google backing, that's huge. De-risks it significantly.
Immensely. These agreements, with extension options, could be worth up to an astounding $8.7 billion in revenue over 2 decades. This news, plus a separate deal for land for a massive 400 million UW infrastructure expansion, pivoted the company's narrative from pure-play Bitcoin miner to a major institutionally backed AI infrastructure provider.
Okay, AI infrastructure is a much better story right now than Bitcoin mining.
Far more stable, high growth, strategically important, it instantly re-rated the stock.
And the Uruguayan online payments firm dLocal, DLO, also surged, right? Over 30%. What drove that?
Yes, dLocal surged plus 33.42%. A direct reaction to a stellar second quarter earnings report released after the close on August 13th. The company announced its total payment volume increased a remarkable 53% year-over-year to a record $9.2 billion.
53% growth. Impressive.
Very. Citing sustained momentum, management also confidently raised its full-year guidance for both revenue and profit growth.
Ah, the magic combo. Beat and raise guidance.
Exactly. The ideal scenario for a growth stock, signaling continued acceleration.
Beyond guidance, our sources point to post-earnings reality checks and dilution fears as another major driver, like CoreWeave, CRWV, plummeting, despite being an AI.
Right. CoreWeave, an AI-focused cloud provider, plummeted negative 14.84%, continuing a multi-day slide after its earnings report. Despite beating revenue estimates, investor focus shifted to the significant risks in its business model.
What kind of risks?
Concerns center on its massive debt load and eye-watering $13 billion in 2024 and its soaring interest expense, which hit $267 million in the second quarter alone.
$13 billion in debt.
Yeah.
Wow. That's a red flag with potentially higher rates.
Huge red flag. The selling pressure was further exacerbated by the fact that the company's post-IPO lockup period was set to expire at the close of trading on August 14th.
Ah, the lockup expiration. So insiders could start selling.
Correct. Freeing insiders and early shareholders to sell, often leading to a flood of supply. A perfect storm for the stock.
What about Coherent Core, COHR? It tumbled over 20% even though it beat estimates. Why?
It did beat. The photonics and materials company beat fiscal fourth quarter estimates for both earnings and revenue. However, its revenue guidance for the upcoming first quarter came in slightly below consensus.
Just slightly below. And it dropped 20%.
Yes. While management explained the miss was due to the intentional divestiture of its aerospace and defense business, a strategic move, the market reacted negatively to any signal of decelerating top-line growth.
Even if there was a good reason for it.
Regardless of the reason, this again emphasizes the market's laser focus on future growth and its extreme intolerance for anything less than perfection or continuous acceleration. No benefit of the doubt.
And finally, companies announcing stock offerings like 180 Life Sciences, ATNF, and Eve Holding, EVEX, they got crushed.
Absolutely crushed. These stocks collapsed negative 28.17% and negative 3.93% respectively, two of the day's worst performers.
Wow.
Both sell-offs were driven by corporate actions threatening to severely dilute existing shareholders.
And dilution is toxic right now, then.
Very toxic. 180 Life Sciences announced plans to sell up to $500 million in stock through an at-the-market offering. Eve Holding announced a $230 million registered direct offering at a significant discount. This really highlights the market's intense aversion to dilution, especially when companies need to raise equity, suggesting maybe they can't rely on debt or internal cash flow.
So we've covered the U.S. market in detail, but what about the global reaction? Our sources show a highly desynchronized picture, largely dictated by the timing of that crucial U.S. PPI release.
That's an excellent way to put it. It's like different parts of the world heard the news at different times. If we connect this to the bigger picture, Europe showed surprising resilience. Major European indices closed broadly higher, appearing to shrug off the U.S. inflation concerns, at least initially.
Europe held up. Interesting.
Yeah. Germany's DAX index finished up plus 0.79%. France's CAC 40 rose plus 0.84%. The Pan-European Stoxx 600 gained plus 0.55%.
That's interesting given the U.S. news. What do you think explains their strength? Were they just late to react or something else?
The resilience suggests investors there were heavily focused on regional factors, like a slate of generally positive corporate earnings reports providing a domestic tailwind. Plus, Eurozone GDP data, while weak at 0.1% growth, was in line with estimates, no negative surprise.
Okay, so local news was good enough.
Possibly. And crucially, European markets were open during and after the U.S. PPI release. Their ability to hold gains indicates the U.S. data was perhaps viewed as a U.S.-specific problem.
Especially the tariff part.
Especially the tariff part, which is less direct for Europe. Or perhaps their own domestic drivers were simply strong enough to offset the negative sentiment.
In contrast, Asian markets seem to have largely retreated. Why the difference?
Major Asian markets closed broadly lower, but here's the key. Their trading sessions concluded before the U.S. PPI data was released.
Ah, so they didn't even know about the PPI shock yet.
Exactly. Their performance was not a reaction to the inflation shock. Instead, the declines were largely attributed to profit-taking and consolidation after a strong multi-day rally.
And that prior rally in Asia was largely fueled by the previous benign U.S. CPI report and the resulting hopes for a Fed rate cut, wasn't it?
Precisely. So they were celebrating something that the PPI then threw into significant question for the rest of the world. Talk about timing.
So who fell in Asia?
Japan's Nikkei 225, which had just set a record high, pulled back by negative 1.1%. In China, the Shanghai Composite lost negative 0.46%, while Hong Kong's Hang Seng Index declined by negative 0.37%. This desynchronized global reaction highlights a potential fracturing of the highly correlated global market movements we've seen recently. Regional factors might be reasserting influence.
Interesting. So maybe a less lockstep movement globally?
Could be. The full impact of the U.S. inflation shock will likely not be felt in Asian markets until their next trading session on Friday, setting up the potential for a negative gap down opening as they're forced to catch up to the new reality priced in by U.S. markets. They'll be playing catch-up.
Okay, so as we bring all these threads together, what's the synthesis of August 14th? It truly injected a significant dose of caution into the market outlook. It shifted sentiment from unbridled bullishness to what our sources call a careful balance of opportunity and caution. Sounds like a tightrope walk.
It really does. Analysts are grappling with a market that's technically stretched, fundamentally expensive, and suddenly facing a renewed macroeconomic headwind. From a technical perspective, signs of exhaustion and a potential intermediate-term correction are emerging. Strategists are watching critical support levels for the S&P 500.
Where are those key levels?
A tentative floor is seen at 6,400, with the more significant level of support down at 6,200. On the upside, FundStrat's Mark Newton noted the index could face formidable resistance, pushing further into all-time highs. Suggests an uphill battle.
And what about momentum and seasonality? Other technical worries?
Yes, the technical picture is clouded by several developing negatives. Javid Mirza at Raymond James pointed to weakening short-term price momentum across major indices. The upward force is losing steam.
Okay, momentum fading.
He also highlights the looming headwind of negative seasonality. August through October often sees higher volatility.
Right, the fall swoon potential.
Exactly. He concludes the reward-risk ratio at current levels is poor, suggesting a 1 to 3 month corrective phase may be underway.
That VIX paradox, though, remaining historically low despite the shock. How is that interpreted again? Complacency or concentration?
It can be read two ways, either as dangerous investor complacency and underestimation of risk, the market just hasn't fully registered the shift yet, or perhaps it reflects that the fear isn't widespread, but highly concentrated in specific segments like small caps and tariff-sensitive stocks, as we discussed.
So the pain isn't universal yet.
Exactly. If the fear isn't broadly distributed, it might not fully register on a broad index like the VIX. The panic might be localized, but potent where it exists.
So what does this all mean from a fundamental perspective? Is the market still supported by strong earnings, or are valuations just too high?
Fundamentally, it's that tightrope walk between a strong earnings foundation and stretched valuations. The S&P 500 is trading at a forward price-to-earnings ratio of 22.2.
22.2? That's high historically, isn't it?
It is a significant premium to its 10-year average of 18.5. Investors are paying considerably more for each dollar of future earnings. This led analysts at Morningstar to conclude that at its current valuation, there is no margin of safety to compensate investors for any of the myriad risks on the horizon.
No margin for error.
Pretty much. The market has priced in a lot of good news, leaving very little room for negative surprises.
But what's the primary pillar of fundamental support preventing a deeper downturn? Something's holding the floor, right?
The exceptionally strong second quarter earnings season remains the primary pillar. That's the backstop. With most companies reported, the blended S&P 500 earnings per share growth rate is tracking at an impressive plus 13.2%.
13% earnings growth is strong.
Very strong. A dramatic outperformance compared to the 5.8% growth expected at the start of the season. Companies are making good money. That underlying corporate profitability provides a strong fundamental foundation that has, so far, prevented a more severe downturn, despite the inflation concerns. Corporate resilience is key.
So, looking ahead, what are the upcoming catalysts and risks investors need to watch? End of the week? Next week? What's on the radar?
The week's not over. Retail sales data due Friday will be critical for gauging consumer health amidst these pressures.
How's the consumer holding up? Big question.
Crucial question. Geopolitically, a scheduled meeting between the U.S. and Russian presidents on Friday is being watched as a potential source of volatility, especially for commodities like oil and gold.
Geopolitics always a wild card.
Always. And earnings season continues, winding down. Semiconductor equipment maker Applied Materials, AMAT, reported after the close Thursday key barometer for the AI chip market. Then focus shifts next week to major retailers like Walmart and Target. Their results will offer more insight into consumer behavior and the real impact of inflation.
Okay, lots still to watch. So, what's the final synthesis of this deep dive? After all this unpacking, what's the core message for our listener?
The market stands decisively at a crossroads. The bullish narrative, AI-fueled earnings growth, Fed pivot hopes, has collided head-on with the bearish reality of persistent, policy-driven wholesale inflation.
Bull versus bear, head-on collision.
Exactly. The path forward will be determined by which of these two powerful conflicting forces proves stronger. Investors must now navigate a complex landscape where headline indices can mask significant internal weakness, where forward guidance ruthlessly trumps past performance.
And where unexpected macro data can trigger violent repricing.
Right. The easy money phase of the 2025 rally, the broad participation rally, appears to be over. It's been replaced by a more challenging and volatile environment that will demand a heightened focus on active risk management and a discerning eye for fundamental strength. You can't just ride the index anymore.
What a day of hidden complexities. We've unpacked the August 14th market action, from the surprising producer price index report and the Fed's sudden dilemma to that stark split between mega caps and small caps, and the powerful role of individual corporate narratives.
Our deep dive today reveals a clear message. In this environment, it's simply not enough to just glance at the headlines. You really have to dig deeper. Understanding the underlying forces like the pipeline pressure from producer prices and how that directly impacts monetary policy expectations is absolutely crucial for recognizing where the true risks and opportunities lie.
Right. It's about looking beyond the surface numbers and understanding the mechanics beneath.
Exactly.
We hope this deep dive has given you a clearer, more nuanced picture of what transpired on August 14th and why it matters, helping you feel truly well-informed without feeling overwhelmed. That's always our goal here.
And here's a provocative thought for you to mull over as you consider these dynamics. If the bond market is often seen as the smarter money, a more accurate, less emotional barometer of economic reality.
The so-called smart money.
Right. And its signals are consistently diverging from the headline equity market performance. What does that imply about the inherent stability of the current rally? And what about the broader economic outlook beyond the immediate future? Is the equity market overly optimistic, or is the bond market overly pessimistic?
And how long can they continue telling such different stories?
Exactly. Something to chew on.
Something powerful to think about as you continue to learn and explore. Thank you for joining us for this deep dive. We'll be back soon with another one.